Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the Investor's Edge. First up, the week in review, China and Fed in focus. So stocks experienced their worst day since May on Monday, with the Dow falling 900 points as investors worried about the meltdown of Chinese real estate firm Evergrande. The fear rippled around the world as many speculated whether or not the credit issues in China could spark a contagion similar to the financial crisis of 2008. Let me be clear, we do not share that view. The next item on investors' list of worries was the potential for the Federal Reserve to announce the reduction or tapering of its bond buying program, something many feel has kept the markets on the rise. While the Fed stated they are close to making the decision to taper, they stopped short of actually making that decision, and the markets rebounded nicely from their pullback earlier in the week. For this week's featured insight, beware the yields quoted on bond funds. It's very challenging these days to find conservative investments, that is, investments that offer a strong degree of stability of principal, that also offer much in the way of return. Most CD rates are well under 1% currently, and the 10-year Treasury note, which does carry some duration risk, meaning you could lose money if you don't hold it for 10 years, offers a yield of roughly 1.4%. Those rates of return don't even compensate investors for the rates of inflation they are experiencing. Folks are understandably attracted to investments that appear to offer higher yields while also offering the prospect of relative stability. And there are a lot of bond funds that quote yields well above 2%. Not that great, but still a lot higher than other interest-bearing investments. Don't be fooled. While the current yield may in fact appear attractive, many of the bonds in these portfolios trade at substantial premiums and will therefore lose value over time. You might get 3% on your bond fund, but lose 2% of your principal in the process, offering essentially that same 1% rate of return that you see on other similar type investments. Looking ahead, eye on September jobs. So jobs reports are kind of like elections. Every one is billed as the most important one of our lifetime, at least in economic circles. The one coming up, that is the September jobs report to be released on Friday, October 8th, will actually likely be the most important one we have seen for quite some time. This is for two reasons. Number one, this will be the first jobs report since the end of the supplemental unemployment benefits at the beginning of September, so it'll be interesting to see if there is a surge of new entrants back into the labor market, which is something many employers have been hoping for. And number two, this jobs report has the potential to put the Fed in a box on their decision to taper their monthly bond purchases, which I talked about earlier. A strong report of more than 1 million new jobs will likely guarantee the Fed must move forward with reducing its monetary stimulus, and the stock market may not respond too kindly, at least in the short term. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Thanks for watching the video. Be sure to like, subscribe, and hit that little bell for notifications. And also make sure to connect with us on Twitter, Facebook, and LinkedIn. For all of your business news, visit businessjournaldaily.com. For all of your arts and entertainment news, go to afterhoursyoungstown.com.